Bismillahirrahmanirrahim. Assalamu alaikum everyone. My name is Yasir Yamin and I welcome you all in this SBR session. Again, in today's class, we will be continuing with the mock examination, pre-mock exam published by ACCA on December 2024 attempt. This time we are going to attempt a very special question which has been published by ACCA, and this is question number 3 of your mock examination. When I first went through this, briefly went through this question in detail, I'm going to go through this question with you guys. We are going to draft an answer for sure. But when I went through this whole question, at least what satisfied me was the fact that ACCA, keeps on updating itself, and always the questions reflect what is happening around us. So whatever you read and whatever you learn in this particular question, that's all what you see around you, the type of transactions that you see happening nowadays. If you monitor the environment closely, you'll see, yes, definitely I've heard about this transaction. Definitely I've heard about that transaction. Maybe not in an accounting perspective, but you have seen such type of things happening around you. And then when you see the accounting impacts of it, when you are examined about the accounting impacts of it, you get more and more updated with the current prevailing environment. So that's the best part of this question. All right, so without any further ado, let's begin question number 3 of ACCA's December 2024 pre-mock examination. All right, and I want you to be very attentive, by the way. So examiner says Edrento constructs residential buildings to sell and rent out. It's imperative, right? It's imperative in question number 3 and question number 4 in particular, because see, question number 3 and question number 4 are always going to be case study questions. And whenever you read a case study, whether it's in SBR or SBL or any other paper, whenever you go through the case study, the company's industry and its environment is always relevant for you, right? So it may be not as much relevant like if you're doing question number 1 or maybe question number 2, but in question number 3 or question number 4, the industry, the environment, the what's happening around you, that's always important. Always keep a focus on this. So Advento constructs residential building to sell. So if you're constructing residential buildings in order to sell them in the ordinary course of business, then whatever buildings you construct, that construction process is basically a production process. Like I can say, like, for example, I have a factory in which I construct this mouse. I manufacture this mouse. So the whole manufacturing process will include me putting together the parts and going through the laborious process or maybe an automated process, and at the end of the day I will get hold of this mouse. Likewise, if your business is to sell buildings, construct and sell buildings, then your manufacturing process is basically the construction process. So whatever cement, steel, whatever raw materials you bring in, whatever laborious process you go through, and you finally construct the house building, all of that is the manufacturing process. And the end product that you get, a large house, maybe a large apartment, maybe a large residential colony, maybe, if you use it to sell that building in the ordinary course of business, that the whatever final good you get is your inventory. All right, the other part is that Edrento also constructs residential buildings in order to rent them out. Now if you're constructing a building, so here IS 40 would be applicable, because you are getting hold of a building, which will primarily be used for the purpose of capital appreciation or rental, in this case rental purpose in particular. So if you're using a building, if you're using a property for the purpose of rental, technically IS 40 will be applicable. So two accounting standards, if I were you, I was there in the question, if I were there on the examination, two things I would have got rightly so from the first line of the question. If I sell buildings in the ordinary course of business, whatever buildings I have, that is my inventory. If I use them for rental purpose, those are my investment property. IS 2 and IS 40 are definitely going to be applicable. Examiner says it prepares its financial statements using IFRS accounting standards, and the financial year end is 31st of December 20x5. Very important to be noted. Examiner says the following exhibits available on the left-hand side of the screen provide relevant information to the question. There are going to be three exhibits. The first exhibit is about greenhouse gas emissions. If I were you in the examination, the first thing that would come into my mind is something about sustainability. So I might get myself ready about sustainability, the sustainability standards, S1 and S2, why sustainability information is important, and so on and so forth. So it says greenhouse gas emissions. This will provide information about Adrento's commitment to reduce greenhouse gas emissions. Again, sustainability is the core agenda of the company. Then there is the second exhibit, which is about apartment buildings. This exhibit will provide you information about one of the apartment buildings held by Adrento. Now, you hold a particular apartment building, but for what purpose? You hold that in order to sell it in future in the ordinary course of business, then it's your inventory. Otherwise, if you hold that for the purpose of rental, then it's your investment property. Then the third part is social influencer. Now, this provides information about a contract between Adrento and a social influencer. Very common thing we see nowadays. I don't know if you use social media every now and then. For sure, if anyone is living in the Middle East, you would definitely see many videos coming on where, social media influencers come and they tell you about Dubai's X property or Y property or Z property, or how you can purchase a property in, let's say, in India, let's say, anywhere in the world. So it's a common business nowadays. I recently saw a video, a social media influencer from Pakistan whose name is Junaid Akram. And he was actually marketing a premises which was in US. For me, it was very much surprising. It was so surprising that I saw the whole video. So he was basically telling us that, if you come to this particular state, this is the place that you can live. This is the amount of money that you've got to invest. You can also rent it out and earn certain amount of money. What are the basic amenities that you're going to be, you are provided, so on and so forth. So certainly, social media influencers have a very great role in marketing these sort of apartments and buildings and properties, right? Because the usage of social media is so much that it's become the best platform. It's become the best platform to reach to your targeted customers. And likely so, social media has the advantage for companies. Social media has definitely advantage that when you put up your advertisement, you can actually target your audience. So, for example, in a TV channel, you cannot target your audience. Whoever watches that channel, maybe a kid or maybe an elderly person, maybe from a very humble background or maybe a very rich person, everybody would watch that particular TV channel. So you're not basically targeting your audience. But social media and the applications thereon have the power. They allow you to target the audience. And how you can make sure that your targeted audience sees your video, you use the help of social media influencers. So there is a contract between a company and the social media influencer, and we would have to do some accounting for it. Now, as per my practice, I would go on to the requirement phase first. I see that there are three requirements to the question A, B, and C. The first requirement is of 5 marks only. And here your examiner says that using exhibit 1 only. So you only focus on exhibit 1 for this part. And in accordance with IAS 37 provisions, contingent liabilities, and contingent assets, explain whether Adrento was correct to recognize a provision for the cost of its strategies to reduce greenhouse gas emissions in its financial statements for the year ended 31st December 20x5. So it's pretty much apparent by the requirement that for the first exhibit, which is for 5 marks only, we are only going to be tested for IS 37. And as far as IS 37 is concerned, if I were you in the examination, IS 37 would start to roll out in my mind, right? So IS 37 requires you to create a provision once three conditions have been met, right? So those three conditions are there must be a present obligation arising through past events, and that present obligation can arise as a result of a legal implication or maybe a contractual obligation can arise as well. Contractual obligations arise when there is a published policy or a past practice that obliges the company to follow a certain act and that involves outflow of economic benefits. And then the second requirement is that the outflow must be probable, right? So there are more likely than not chances that the outflow is going to happen. And then the third requirement is that there must be a reliable estimate available. When these three requirements are met, you are allowed to create a provision. Now, in light of this knowledge, we would go and read the exhibit and see if Edrento was correct to recognize a provision for the cost of its strategies to reduce greenhouse gas emissions. That is our target. Let's open exhibit number 1. Now, when we open exhibit number 1, it says in May 20x5. So it's about 8 months before the accounting year end, right? So in May 20x5, at Adrento's annual general meeting, AGM, the directors announced to shareholders that the company was committing to reduce its Scope 1 net greenhouse gas emissions by 80% by 31st of December 20x9. Now, let me ask you a question. Have you heard about Scope 1 net emissions before? And if yes, where did we hear about it? Where did we discuss scope 1 greenhouse gas emissions? This terminology must be not exactly new to you. Why? Yes, we discussed this in sustainability standards. In particular, we discussed about scope 1 and scope 2 net greenhouse gas emissions in your S2 standard, right? But that was all about disclosure, not particularly linked to IS 37. Now, here what happens is that Edrento went into its general meeting and they publicly committed that we are going to reduce our scope 1. Scope 1 net greenhouse gas emissions are the direct emissions which are contributed by the entity. So we aim to reduce 80% of our net greenhouse gas emissions by 31st of December 20x9. So I would say that around 4.5 years are to go, 4 years and 8 months are to go while by when you have to, you know, achieve your target. And many companies are doing that, by the way. Examiner says that directors also announced two ways to achieve it. So the announcement was publicly made and they noted down because they had to give a disclosure. So they decided to disclose how they are going to achieve their targets of reducing 80% of their greenhouse gas emissions. The first way was most greenhouse gas emissions on construction sites are related to burning of diesel fuel. Adrento will therefore invest in battery energy storage systems for use on its construction sites to reduce reliance on energy from diesel fuel. So, the first action that Adrento is publicly committing to is that they intend to invest in battery energy storage systems on their construction sites so that they reduce their reliance on energy which is generated from generators which use diesel fuel. So basically, they are going to gradually shift themselves from diesel gensets to, battery storage systems. And those batteries might get charged from solar or something like that. So they want to take a positive action by, within next 4 years. All right. Adrento intends to order. Please note this down. Adrento intends to order. Let me ask you one thing. If you intend to do something, does it become an obligation on you? I'm not talking about a moral obligation. I'm talking about a legal or a constructive obligation. You see, th this is the commercial substance. Whatever you intend, your intentions or the intention of directors do not create a present obligation as per se. So what they are saying is Adrento intends to order several of these systems at a total cost of $10 million for deliveries between X6 and X7. But please note this down. Adrento intends to place this order, but the order has not yet been made. So there is no legal binding obligation upon us to incur this outflow. Make sense? The directors have stated that despite this investment, all construction projects are still expected to make a profit. So there is nothing that would lead these construction projects into loss. So basically, we are just compensating the amount of money that we used to spend on diesel fuel. We are just compensating that cost from a new cost, and that cost is going to be $10 million, which we are going to invest in systems, battery storage systems. All right. So this is one of our agendas. This is how we are going to reduce 80% of our emissions. The second point, to the extent that the use of the battery energy storage systems does not reduce scope 1 net greenhouse gas emissions by 80% compared to the current levels, Adrento will buy carbon credits in each of the years 20x6 to 20x9 inclusive. So basically, they are committing to this feature. They are saying, first of all, we are going to invest in our own resources. We care about the climate, and therefore we are going to invest in our own resources. We are going to get rid of 80% of the greenhouse gas emissions by installing, battery storage, servers or systems that enable us to use green energy. But up to the extent that we are unable to achieve the set target of 80%, we are going to buy carbon credits from the market. Now, carbon credits are like, government instruments that that is like a penalty upon the company when you fail to achieve a certain target which is set by the government. So let's say the government is saying, okay, if you do not reduce your greenhouse gas emissions by 80%, then you will have to buy the government securities up to the extent of a certain amount. Or maybe you'll have to buy these carbon credits from another company who is more compliant as far as greenhouse gas emissions are concerned. So for you, this will be a penalty. We will penalize you because you're not achieving the target which is set by the government, and the other company which is achieving that target, they will be rewarded, through your investment. So basically, Adrento will buy carbon credits in each of the following years, X6 till X9, 4 years. It will buy these on the final day of each accounting period. These costs are expected as follows. So the first year, the carbon credits cost is going to be 1.45. Gradually, we are going to reduce this cost up to 0.45 million in X9. Because as we increase our capacity, of battery storage systems, we are going to be more and more compliant and more self-sufficient. And therefore, the way we are penalized, that credit requirement will get low, by the way. So two things that we are going to do. $10 million we are going to spend on battery storage systems. We intend to do that. And $3.78 million we are going to spend on carbon credits. Examiner says in its draft statement of financial position at 31st December X5, Adrento has recognized a provision for the total cost of $13.78 million associated with its strategy to reduce greenhouse gas emissions. So basically, they intend to spend $13.78 million in the future, and they have recognized a provision for that particular amount. My question to you is this correct accounting treatment, yes or no? First question is yes or no. Then I'll ask the second question. Okay. So many of you are saying that, provision should not be recognized. But why? We'll go phase by phase. Let's say I ask you, why should we not be creating a provision for $10 million? I mean, we have made a public statement that we intend to invest in battery storage systems, which are going to be delivered in the upcoming years, 20x6 and 20x7. Why do you think there is no provision can be recognized? So one of the students says that there is no legal or constructive obligation. I mean, yes, there is no legal obligation upon you. You have made a public announcement, but you can always go back from your announcement, right? So management's intention does not create a uh, legal obligation upon you. And there are no published policies or past practices that mandatorily, require you to install these battery storage systems. I mean, this is the first time that you're doing it. So there is no past practice through which we can establish that, for example, the previous time you made such an announcement, you made this investment, there is nothing to get established. And furthermore, if you think about it, even if, let's say, I would just, being devil's advocate, I would think otherwise. Let's say I had already purchased an order to a supplier to deliver these battery storage systems in 20x7 and 20x6 and 20x7. Believe you me, even then, a provision couldn't have been recognized. Because you see, you recognize a provision against an outflow. If you gave a purchase order to your supplier for deliveries in 20x6 and 20x7, you are only liable to pay that supplier once you get the delivery of it. So until you get a delivery of it, there is no liability, right? And if there is a purchase order to it, it's not a provision, it's not an estimated liability. It is always going to be recognized as a confirmed liability. Make sense? So in either case, in whatever manner you think, this is very clear that for these $10 million, no provision can be recognized. There is no legal obligation. There is no constructive obligation. There is nothing which is supposed to be done. Understood? Does everybody understand? Even if a purchase order had been placed, even then a provision cannot be recognized. Make sense? Make sense? Is it clear to everybody? And then when you talk about carbon credits, let me ask you why carbon credits $3.78 million of amount cannot be recognized as a provision. Why can it not be done? I mean, for the very same reason. You see, first of all, let's say if I were to agree that in future years, maybe 1 year after, second year after, third year after, fourth year after, I had to incur these amounts. I must incur these amounts in terms of buying carbon credits. Even then, the provision could not have been recognized by $3.78 million because IS 37 requires you to accommodate time value of money as well. You see, I'm just saying, even if we decided to recognize a provision for the purchase of carbon credits, even then, a provision could not have been made by the amount of 3.78 million, because these are future cash flows and time value of money should have been accounted for, should have been accommodated in this. You would have to calculate present value of cash flows, then whatever the amount comes, you would recognize a provision for that. So the estimate that directors have currently taken, it is completely wrong. The estimate directors have taken is completely wrong, right? And the second part, is there a present obligation to buy these carbon credits? I mean, is it written anywhere that the government obliges us to buy these carbon credits if we are unable to meet the target which has been set by our own selves? Is there a legal obligation to buy these carbon credits? I mean, to be honest, these $3.78 million which we are going to spend, it was just a marketing tactic. The directors are actually saving their face. They went into the AGM, they wanted to speak something fancy. So they told their shareholders, okay, we are going to spend $13.78 million, hopefully in the next 4 years. Kindly re-elect us. We care about this environment, we care about the society. But you see, in essence, if you see about it, that no firm commitments or no legal obligations occur just by making an announcement in public in front of the shareholders. Make sense? So, merely speaking, generally speaking, it's just a marketing gimmick. It's just a gimmick, nothing else, right? So a provision should not be recognized. Make sense? Now we need to write the same answer in our word processor for sure. So what I'll do is, first of all, I'll copy the requirement just to be sure that we, do not have to go back into the into the requirement part again and again. So I just need to write an answer on IS 37's implication in this scenario. How do I start my answer? Can anybody support me in this? How do I start my answer here? What are the first two words that I should be using? Very good, guys. I want you to help me, please. I might forget something. I want you to help me write an answer because this is how you practice for your own examination. So according to IS 37, a provision, just give me a moment, please. So let us continue, right? So according to IS 37, a provision should be recognized. A provision should be recognized when there is a present obligation arising as a result of past events. The outflow against which is probable, and there is also a reliable estimate available, right? And also a reliable estimate is available. Furthermore, or rather I can write, it should be noted that a provision cannot be recognized just based on intentions of the company or where a present obligation for a future probable outflow cannot be recognized. Then what I will do is I will write heading for the first point, and that was for battery storage systems, right? And I can just write like in this case, right? In this case, if anybody could help me out here, in this case, Adrento intends to invest $10 million in battery storage systems to replace its diesel powered energy system. However, despite an announcement, no firm orders have yet been placed. Therefore, there is no present obligation on the company. Moreover, even if a purchase order had been provided, even then, a liability could only have been recognized when Adrento would receive the delivery of it in 20x6 or and 20x7. Hence, no provision can be recognized. Make sense? All right. So this is about battery storage systems. And then you talk about carbon credits, right? So for carbon credits, in the case of carbon credits, there is, or rather I can write, no legally binding requirement, let's say, from the government has been mentioned. So it is merely an intention of adherent to make up for its uh, target targeted 80% reduction in greenhouse gas emissions through the purchase of carbon credits. Furthermore, there seems to be no evidence for past practices which suggests a constructive obligation on Adrento as a result of this announcement. I presume that anywhere you find where the answer that we are writing is not up to the mark, or maybe I'm missing some point, you'll add on it by yourself. All right. So furthermore, there seems to be no evidence for past practice which suggests a constructive obligation on Redrento as a result of this public announcement. One more point that comes into my mind, other than the ones I have already mentioned, I would like to write, even if there was a present obligation, Adherento, the directors, could not have recognized a provision for $3.78 million because as per IS 37, the future probable outflows should have been discounted at the appropriate cost of capital to present value terms. So the conclusion is, hence, it can be concluded that the provision of $13.78 million recognized is incorrect, and therefore it should be reversed. Guys, let me know if you understand this or not. I want your feedback with an okay or not okay. Uh, I mean, a decent answer. Maybe you can write a better answer than what I am writing. I have full confidence on you guys. You guys are much, 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 much better than me. Whoever is watching this video, you are definitely better than me. And don't point out silly mistakes that I might have done. But all in all, do you understand how to approach such a question? And I'm very sure you'll be able to attempt such a question in an even better manner. All right. Very good. Thank you for the feedback. And once we are done with exhibit number 1, we can move on to the second exhibit. But before I open the second exhibit, let's go through its requirement. So for the second requirement, whereby the mark allocation is 10 marks, a lot of marks here, examiner says using exhibit number 2 and in accordance with IFRS accounting standards, explain how Adrento should account for the apartment building in the year ended 31st December 20x5. So there is some apartment building, and the question is how do you account for it? All right, 10 marks. Wow. Maybe I can just copy paste the requirement from here so I don't have to uh, come back to the requirements channel again. Yep, here I have done it. So let's go first. Let me just close this one. Yeah. So let's just go through the second exhibit. Examiner says Edrento constructs apartment buildings. Okay. It sells some of these and holds the others to rent it to university students. You construct apartment buildings, some you sell and some you hold for rent. It could have been rented to anybody, but you're renting it to university students, does not make any difference. So, like I said earlier, if you hold properties for sale in the ordinary course of business, then whatever properties you have, those are your inventory. And if you have some properties from which you intend to recover economic benefits in the form of rental, then those are your investment properties. All right. Examiner says Green Bank is an apartment building which has been rented to university students. So, okay, Green Bank is an apartment building which has been rented to university students. Can you guys tell me which accounting standard would be applicable here if you're renting out Green Bank to university students? IAS 40. Do you remember the implications of IAS 40? So IAS 40 used to tell you that IAS 40 is investment property. Investment property is any property that is held for the purpose of capital appreciation or rental purpose or both, right? Any property that is held for sale in the ordinary course of business is not carried under IAS 40. Any property which is owner occupied is not under IAS 40. Right. And then we discussed that, if there is a multi-purpose property, how do you do accounting for it? Then under IS 40, we discussed how to do accounting for, how to, measure your investment property. So initially, your investment property is always measured at cost, the purchase cost or the directly attributable cost of the property. But then for subsequent measurement, you have two models, cost model or the fair value model. The cost model is the same model as proposed under IAS 16, whereby you just follow the historical cost concept, depreciate your assets as and when applicable. But then there is another model which is known as fair value model. Under fair value model, you do mark to market of your investment property at each reporting date. All the fair value gains and losses are recognized under profit or loss, and there is no depreciation recognized under fair value model. Furthermore, when we discussed about IAS 40, we also read about the area where we discussed about the change of use, right? So change of use area under IAS 40 was such whereby the accounting standard said that whenever there is a change in use, there will always be a change in accounting standard. For example, previously, if you had a property which you used to rent it out to others, but now you are occupying that property for your own purpose, then since there is a change in use, there will be a change in accounting standard and vice versa. Do you remember? Do you guys remember? I told you if there is a shift from cost model to cost model, then no problem. Just calculate carrying value at the date of change in use and just debit the accounting standard in which you are going and credit the accounting standard from which you are coming. Make sense? Remember? And then I told you that whenever a change in use occurs and due to that change, you are going to change the accounting standard. And even if at either one side of the change, even if at either one side of the change, fair value is mentioned. So basically, whenever you are transitioning towards or from a fair value model, then the steps are that just before the transfer, you calculate the carrying value of the asset. You calculate the carrying value of the asset. You mark to market it under the previous accounting standard. Whatever the fair value under the previous accounting standard is becomes the deemed cost of the new accounting standard, and then you follow the new accounting standard onwards. Make sense? Do you remember IS 40 now? Right? So this is all what we have discussed under IS 40. People often ask me, sir, can you do a revision of the accounting standards? I always do revision of accounting standards by revising the whole accounting standard while doing past papers. So this is my strategy. I don't want you to listen to me about different accounting standards without any questions on it, right? So here, let's go. On 1st May 20x5, which is again 8 months before the year end, examiner says Edrento's management decided that it would not rent the Green Bank apartment building to students in the next academic year and would instead remodel the building and sell it as a single property in the ordinary course of building. What are they saying? On 1st May 20x5, Rento's management decided that from the coming period, we are not going to rent this property to students anymore because they misuse the property, because they destroy the property, or because due to any goddamn reason which the company, has. We don't care. But the company's management decided that we are not going to rent this property anymore from the new session, and rather we are going to sell it. We are just going to remodel it and then sell it. Examiner further says the remodeling started on 1st July X5 after all students had vacated the building. From this, we get to know that the student year or the academic year was from 1st July X5 onwards, which is normally the case. In most of the universities, you always see that the session runs from 1st July to 30th June maybe, right? So this is their academic year. So the remodeling started on 1st July X5 after all students had vacated the building, and a cost of total $350,000 was incurred. I have one question. Is there a change in use? Give me a yes or a no. And yes, you guys have already given me the answer. Yes, there is a change in use. From which standard are we shifting to which standard? We are going from IS 40 investment property to IS 2 to IS 2. Very good. Excellent. 40 to 2. If I ask you one more question, the management decided that the change is going to happen on 1st May 20x5, whereas the remodeling actually started on 1st July X5. What is the date of change in use? What is the date of change in use? Can anybody tell me? Is the date of change in use 1st May or 1st July? The date of change in use is 1st July. The day you started the remodeling. Till 30th June, nobody had vacated the property. It was still rented out. It was an investment property. You see, remember, you need to understand that having an intention to do something does not create a transaction, right? So according to IS 40, whenever there is a change in use, it's not written there is a change in intention. According to IS 40, whenever there is a change in use, there must be a change in accounting standard. So the change in use actually happened on 1st July X5. This is the date of change in use. And so on 1st July X5, we will be shifting from IS 40 to IS 2, right? Examiner says Edrento began to market the building for sale on 1st October 20x5. Naturally, so you would be remodeling it. The building remained unsold on 31st December 20x5, so it is still in your inventory. Selling costs are expected to be $90,000. Very good. Examiner says the building originally costs $1.1 million and it had a carrying amount of $1.6 million at the start of the year. Its fair value was determined as follows. Now, it's important for you to understand that why examiner is giving you fair value of that particular property. It's important because examiner is telling you that it measures investment property using fair value model. So you bought that building for $1.1 million, but since you were using the fair value model, you would have carried it at fair value. So at last reporting date, it had a carrying amount of $1.6 million. This is the last fair value of your property, And after that, multiple dates with fair values are given. So on 1st May 20x5, the fair value of the property was $1.4 million. Can you guys tell me if this is relevant? If this is relevant. Is this relevant to you? No. 1st May X5 is irrelevant to you. It makes you no good. An intention does not create a transaction. Then on 1st July X5, the fair value of the property, whose carrying amount was $1.6 million, the fair value is 1.5. Is this relevant to us? Subrat says, yes. Subrat Kumar, you are absolutely right. Because this $1.5 million is relevant to us because a change in accounting standard is going to happen. A change in accounting standard is going to happen. Yeah. So the property which was being carried in your books of $1.6 million on that will be valued at $1.5 million at the date of change in use. So technically, you have $100,000 worth of fair value loss. I will call it Farah fair value loss rather than impairment. It's under IS 40. So it's a fair value loss. You writing an impairment would, give the impression to the examiner that you're talking about IS 36 as if IS 36 was applicable. IS 36 would have only have been applicable if there was a hint of impairment, right? So IS 36 is not applicable here. Under IS 40, before making a transition, you have to mark to market. And therefore, when you did mark to market, there was a fair value loss of 100,000. Understood? Then a fair value of 1st October 20x5 is given. 1st October 20x5, by the way, is the date. Your market, your in building was available for sale. Is this fair value relevant to me? Is this fair value relevant to me, guys? This $1.9 million on 1st October X5. 1st October X5, by the way, again, repeating it, it is the date we started marketing for selling of this building. Is this $1.9 million relevant to us? After the date of change in use, after change in use, this building becomes our inventory, right? So 1st July X5 onwards, this is our inventory. And for which you have a fair value of $1.9 million on 1st October X5. Is this $1.9 million relevant to me? Under IAS 2, should you be revaluing or fair valuing your inventory on 1st October X5? The answer is no. Yes, it's absolutely irrelevant for us. Yeah. And then Subrat, fair value is also given at 31st December X5 for $1.75 million. Is this relevant to us? Is this fair value of our inventory of $1.75 million relevant to us? We had a property, we had a building in our books, right? And it was not sold by the year end. We have a fair value given. Is it relevant to us? Maybe yes. Maybe yes, because we need to perform NRV testing. We need to perform NRV testing, and that's why this fair value may be important to us. Make sense? Examiner says Adrento measures owner occupied property using the revaluation model and adopts a useful life of 30 years for the building. Adrento uses revaluation model for owner occupied properties and depreciates it over 30 years. is this information relevant to us? Give me a yes or a no. Is this information relevant to us? Everybody, I want an answer from everybody. Why is it not relevant to us? Everybody is saying not relevant to us. Why not relevant? Yeah, this building is not owner occupied. There is no implication of IAS 16 here. We have a building which we are going to sell in the ordinary course of business. IAS 16 is not applicable. Absolutely right. So this information is irrelevant for us. That is why I striked it down. Now my job is to write an answer over this, whatever, based on whatever discussions we have had up till now. So let's write an answer. Again, I would need your support. I know you guys understand about this answer, but again, since we are drafting an answer, we are making a collective effort. I want your opinions, I want your pointers so that I can write a better answer along with you guys. Let's write. So if I were you in the examination, I would start with according to IS 40. I wrote 140. According to IS 40, investment property is a property which is held for the purpose of capital appreciation or rental purpose or both, right? It is also, it should also be noted that any owner occupied property or a property which is held for sale in the ordinary course of business is beyond or is not, or rather is excluded from IS 40. I would further write property held for sale in ordinary course is recognized according to IAS 2. Make sense? Furthermore, since I know from the extract that there is going to be a topic of change in use, I am also going to talk about it, right? Furthermore, as per IS 40, whenever there is a change in use of the property, there should also be a shift in applicable accounting standards. This, I can write in such a scenario, I would write the asset or the property is first measured at fair value at the date of change in use and then transferred fair value with accounting treatment as per prevailing accounting standard at the date of changes use, then it should be transferred to the new accounting standard with fair value being the deemed cost of the new classification. Make sense? Is everybody following me? It is the deemed cost of the new classification. From the date of change in use, new accounting standard is applicable. Then I would write in this case, the property which was, what was the name of the property, by the way? Green Bank, right? Green Bank was used for letting purposes to university students and therefore was rightly classified as an investment property. It was measured in accordance with company policy at fair value of $1.6 million till the last reporting date. However, once Aderento made the change in use on 1st July 20x5, thereafter property should be classified as inventory and accounted for as under IS2. It should be noted that the intention of management as expressed on 1st May 20x5 does not reflect a transaction, and therefore the effective date of change in use is only 1st July, right? So on 1st July, the carrying amount, the property will be valued at fair value. What was the fair value of the property? 1.5 million. Okay. So on 1st July, the property will be valued at fair value of $1.5 million, hence reporting a fair value loss of $100,000, which would be recognized in profit or loss account. From this date, the property would be carried under IS2. On 31st December 20x5, the property would be tested for NRV, for any NRV loss. NRV of the property on 31st December 20x5 would be, how do you calculate NRV? What's the formula of calculating NRV, if anybody could tell me? What's the formula of calculating NRV, by the way? Can anybody tell me? Estimated selling price minus cost to sell minus cost to complete. Estimated selling price minus cost to sell minus cost to complete. So the estimated selling price, the fair value of the inventory at 31st December 20x5 is 1.75 million. Whereas if you see into the question, the selling cost which is expected, the building remain unsold on 31st December 20x5, the building remain unsold on 31st December 20x5, selling costs are expected to be $90,000. So if anybody could do 1.75 minus zero point 0.9, what is the answer? Can you guys tell me? Otherwise, I'll have to calculate it myself. 1.75 minus 0.9, or sorry, 0.09. It is 1.66. So I would write like the property would be tested for any NRV loss. NRV of the property on 31st December 20x5 would be $1.66 million, which is $1.75 minus 0.09 million. The cost of the inventory at this date would be dollar. What was the cost of the property? What was the cost of the property? We measured it at 1.5 million. Yeah. We measured it at 1.5 million, and the NRV came to be 1.66 million. The cost of the inventory at this date was $1.5 million. Is there any NRV loss? Is there any NRV loss? Hello, is there any NRV loss? Lower of cost or NRV? The lower of cost or NRV would prevail. Is it clear to everybody? Is this clear to everybody? A decent answer that I could have written in so much time. Is it clear to everybody? Let me know. Yeah. If it's clear to everybody, then we move on to the third part. Yeah. As we move on to the third part, which is last part of this question, you need to make sure that you stay attentive. Please stay attentive. All right. So last 10 marks requirement, we have already taken a lot of time. I hope that you do not take this much time while you are writing an answer in your examination, and that you could only do when you practice a lot. All right. So you should be very well, you must be comfortable with the keyboard environment, and you're good with your typing speed and everything. And this will help you definitely while writing your answer. So C part, it says using exhibit 3 and in accordance with IFRS, evaluate the accounting treatment which is to be applied to the amounts paid to social media influencers in the year ended 31st December 20x5. All right. For 10 marks, you need to go through this third exhibit. Let me just copy it down. I close this up. Done. All right. The third exhibit now. Examiner says a social influencer is an individual with credibility in a particular industry and a large following on a social media. So at least ACCA is telling us who is a social media influencer. I mean, do you guys agree that this is now indeed a career on its own? Do you think social media, being a social media influencer, is a career now? Definitely, yes, you're correct. So being a social media influencer is a very lucrative career for many people in this world. I don't know if you would agree or not. I mean, it's debatable if it's a good career or not, if it's a wise career or not. It's if it's easier for you to stay on the right path or not if you are following that path, but still it is a career. So your examiner is saying on 1st November 20x5, which is just 2 months before the accounting year end, Adrento engaged a social influencer to build awareness of its brand, of its brand. So Adrento hired a social media influencer, just like ACCA Online hired a social media influencer so that you can build an image out of the brand. So I hired an agency, I hired a social media influencer whose core job was to build awareness of the brand. It is a marketing arrangement, nothing else. And, and remember the word is and, right? So, and bifurcates the sentence. So it says, and to promote new buildings in new apartments in two buildings, River Park, one of the areas, and Moore Place, the other area, on social media platforms. So basically, two arrangements we have made with the social media influencer. The first arrangement is that that social media influencer is going to build awareness of our brand into the market, and also a deal is happening with the social media influencer whereby he is required to promote new apartments in my two buildings, River Park and Moore Place. All right. Examiner says construction of both buildings began on 1st October X5 and is expected to be completed on 31st January X6. Right. Examiner says Adrento intended to lease the 80 apartments in River Park to university students under 12-month operating lease contracts running from 1st August X5 to 31st July X6. Maybe this is the academic year. So basically what I understand is that River Park, which is one of the buildings for 80 apartments in River Parks, our intention is to allot these 80 apartments under a 12-month operating lease. What type of properties would these be? What type of properties would these be? These 80 apartments in River Park building, we intend to rent them out to university students. Which accounting standard is being made applicable here? Which accounting standard is applicable here? IFRS 16. All right. IFRS 16. Very good. Why do you say IFRS 16, by the way? I'm leasing out the contracts to other parties. That is why on 12-month operating leases, that is why you are saying IFRS 16 is applicable. Rightfully so. Okay, Shoaib, you tell me, am I a lessor or a lessee? Am I a lessor or a lessee? I am a lessor. Okay. So few things you understand. I have a property in my hand, which I am going to lease it out for 12 months to another party. I am a lessor. I am going to lease out an asset which is owned by me, for which all the commercial ownership is with me. I'm going to lease it out to another party under a 12-month contract. I am a lessor and I'm going in a 12-month arrangement. That means it's an operating lease because significant risk and rewards of the property would not be transferred to the other party who is only taking that property, who are university students and who are only taking this property for a period of 12 months. So technically, this is an operating lease, and even examiner has specified that this is an operating lease. So I am a lessor. I am just providing my asset to use to another party for a short period of time of 12 months, and against which I will be entitled to dash. I will be entitled to dash. What is the dash? What will I get when I rent these out? Okay, somebody says, yes, sir, you will be entitled to rental expense. Okay, so technically, I rent out my property to a student and I also pay them. Is that what, Sania, you are trying to say? Oh, you are living in my house. Oh, please take this money from me. Oh, you mean rental income. Absolutely. So IFRS 16 is applicable. I am going to earn rental income out of this property. Can I use a line in Urdu, and I'll repeat this in English as well. I always used to tell you when I was teaching you IFRS 16, लीज की कहानी के हमेशा दो पहलू होते हैं, एक डेबिट साइड वाला और एक क्रेडिट साइड वाला। बोलता था नहीं बोलता था? I always used to tell you that a lease story always have two side effects, right? One is the credit side effect and one is the debit side effect. A lease story is always two-sided, right? So the credit side effect, as far as we understand, whenever I'm giving a property of my own, whenever I'm giving an asset of my own to some other party, I am going to earn rental income over it. That is the credit side part. Understood? And obviously there will be a debit in cash, but regardless of that, the story, the story is around credit side of rental income, right? Makes sense. But isn't there a debit side story as well? I have a property which I am renting out to others to earn rental income. The rental income in itself is under IFRS 16. Totally agreed. The rental income in itself is under IFRS 16, and IFRS 16 provides for this fact that operating leases income should be recognized under P&L as and when they are receivable. Totally agreed. But don't you think the property in itself, which is being rented out, the property in itself is an investment property, right? So now you guys agree that there are two stories to one transaction. One side, no, Farah, there is no concept of substance over form here. I mean, it's common sense. Though we are talking about IFRS 16 because examiner says that we are going to lease out these apartments of River Park to students, I understand that you are more concerned about rental income here. But at the same time, in maybe a parallel universe, don't you understand that this property in itself is a property which is being rented out to others? So, as far as the property is concerned, it would be carried under IAS 40. As far as the income from that property is concerned, that will be credited to P&L in accordance with IFRS 16. So, technically, Farah, both accounting standards are applicable simultaneously. Both accounting standards are applicable simultaneously. Do you agree? Everybody, right? So, first of all, this needs to be established that IAS 40 and IFRS 16 both are applicable simultaneously. And both accounting standards have different roles over it. A lease accounting standard talks about the transaction, how to account for that transaction. Whereas the underlying asset, which is subject to a lease, the underlying asset is under IS 40. Understood? So IS 40 and IFRS 16 both are applicable in the case of River Park. Totally agreed. So let me read it again. Adrento intended to lease 80 apartments in the River Park to university students under a 12-month operating lease contract running from 1st August X5 to 31st July X6. It intended to sell 60 apartments. Now, this is something else, right? So please focus on this. Examiner says it intended to sell the 60 apartments in Moore Place to individual purchasers in the ordinary course of ordinary course of business. As far as River Park is concerned, their 80 apartments are held for the purpose of rental income. As far as Moore Place is concerned, these 60 apartments are held for the purpose of sale in the ordinary course of business. Can I say for the Moore Place 60 apartments, it is inventory that we are talking about. It is inventory that we are talking about. So the third accounting standard that is in there in the question, IFRS 16, IAS 40, and IAS 2. Totally agreed. Done. Right? Can I move forward? Now the examiner says, the contract with the social influencer had a term of 3 months, and Adrento agreed to pay them. Now, these 3 points will outline, how that social media influencer would be paid. He would be paid an initial fixed fee of $180,000. Oh my God, a lot of money. A lot of money where you're talking about. So $180,000 is paid to the social media influencer. Why would this fixed fee be paid to the social media influencer? Fixed fee. You call out a social media influencer, yeah, and you ask them to market your buildings and to create your brand awareness, and you're going to pay them for $180,000. Can I say this fixed fee of $180,000 is being paid to market your business, market your infra? Do you agree with this? So this $180,000 is a pure marketing expense for you. Do you agree with this? And by the way, marketing expenses or brand building expenses or internally developed brand names or internally developed in cost incurred to develop your internally developed brand can never be capitalized. Remember. So this $180,000 is a pure marketing expense which should be recognized in P&L over the contract period. So if we hired the social media influencer for a period of 3 months, then this $180,000 should be recognized in P&L over a period of 3 months. We hired this influencer on 1st November X5. So $180,000 should be amortized over 3 months. So at least 2 months of a marketing expenditure should be recognized. Do you all agree? Do you all agree? I want an answer from everybody. Are you guys comfortable? Right? The second point. Examiner says $500 for each river park. Now, this is a term in the contract. $500 for each river park apartment lease contract signed as a result of influencers' promotional activities. In addition to a fixed fee, we want to motivate the social media influencer. We want him to, put stuff in their stories and, create, exciting reels. So what we are saying to our social media influencer is that as a result of your promotional activities, whatever apartments we sell, per apartment, we are going to pay you $500. Don't you think this is a sales commission? Yes, Farah. Absolutely right. This is a sales commission that we are paying to the other party. Yeah. And this should be recognized, this should be recognized as an expense. This should be recognized as an expense. But wait. We are talking about river park apartment lease contracts. Do you guys remember what purpose river park was to be used? So river park was to be used to, you know, these apartments were to be used for the purpose of rental. Yeah. So we were to initiate lease contracts through river park. And you guys said, sir, that River Park, the apartments of River Park and the lease contracts that we are going to enter into should be treated under IFRS 16. So while you are referring to IFRS 16, let me tell you one thing. You see, normally speaking, $500 paid for a purpose of sale. $500 paid for a purpose of sale is supposed to be a sales commission. And sales commission is a selling expense. It is always written down into P&L. Are you guys following me or not? Otherwise, you will be making a big mistake. Guys, normally speaking, whenever you pay a person a commission, a sales commission, it is a selling expense. And it is always written down in P&L as and when incurred. Right? But in this case, you are paying $500 not for the purpose of sale, but for the purpose of ensuring that The apartments in River Park get the stipulated lease contracts. So it's basically a commission paid on lease. It's a commission paid on lease. Do you all agree? It is not a commission on sale, it is a commission on lease. Agreed? And that lease is accounted for under IFRS 16. So under IFRS 16, there is a requirement which says that all initial direct cost attributable to the lease, all initial direct cost attributable to the lease should be capitalized. Should be capitalized. And then it should be amortized over the same period rental income is earned. Otherwise, there will be a mismatch, na? For example, we intend to rent out these properties to university students. Make sense? So let's say there were 80 apartments in River Park, and we rented out all of them with the support of social media influencer. We rented out all of them. Make sense? Now the rental income will come over the period of 12 months. But we incurred an expenditure in order to initiate this lease, in order to enter into this lease. We incurred an expense of $500 per apartment as an initial direct cost to obtain a lease. Would it be correct to recognize this $500 per apartment as an expense now and then recognize all the rental income over the 12-month period? Would this be matching? Think about it. Think about it. IFRS 16, whatever any accounting standard says, is always common sense. Would it be common sense? Would it be fair? Would it be faithful representation of financial affairs if you recognize an income over the period of next 12 months, but an expense that was directly attributable to obtaining that lease, the efforts of social media influencer, you recognize it as an expense now? Is it fair? IFRS 16 says no. So what do? Whatever amount of commission you deem that is payable to the social media influencer, or that is paid to the social media influencer, is capitalized at the start of the lease. And then whatever amount was paid to social media influencer will ultimately be recognized as an expense, but over the period of the lease term, so that there is matching between incomes and expenses. Does everybody understand this? I want an answer from everybody. Does everybody understand this? Guys, I want an answer from everybody. Right? So I think, you need to think about it. And if you really understand this is one of the reasons, I think that examiner has blessed us by providing such a question, because we would have, it would have been much easier for you to make a silly mistake here, right? But if you think about it, it would be fair representation if you match the incomes with expenses, and now you feel it common sense. Now you're more prepared for your real examination if a similar scenario comes into the real exam. So we should thank our examiner. We should thank ACCA that they are providing us a pre-December mock. Now let's talk about the third condition of the contract. A $1,200 for each deposit. So we have to pay social media influencer $1,200 for each deposit received on a Moore Place apartment as a result of the influencer's promotional activities. So as far as Moore Place apartment is concerned, do you guys remember for what purpose Moore Place apartment was to be used? Now these were 60 apartments in Moore Place, which were to be sold in the ordinary course of business, right? So we have to pay $1,200 to our social media influencer for every deposit received on Moore Place apartment. Can I say this $1,200 is a pure sales commission? The previous one was basically a lease commission, and this is a pure sales commission. Do you agree with this? I want an answer from everybody, you guys. This is a pure sales commission. $1,200 will be payable to the social media influencer once we receive the deposit from the customer in Moore Place, and Moore Place was used as an inventory. We are going to sell these items of inventory. Can I say this is sales commission? Yes, this is sales commission, right? So we are eventually going to sell something. We are going to sell some apartments, and we have promised our social media influencer that even if we receive the deposit, even if we receive the deposit for the future sale, we are going to pay you $1,200. So we are basically providing. Okay, so there is a question by Subrat Kumar. How both commissions are different? I missed that part. Both commissions are different in terms of what purpose they are fulfilling. The $500 commission was for River Park apartment, and River Park apartment was an investment property. You were using that property for the purpose of lease. So it's basically a commission for lease. It's a directly attributable cost, an initial direct cost to obtain a lease. It's by way of accounting, it's different. But when you talk about Moore Place apartment, when you talk about Moore Place apartment, the $1,200 that you are paying to social media influencer, yes, this is a commission, but this is a commission for sale. The previous one was commission for rental purpose. The second one is commission for sale. Subrat, do I answer your question? Yeah. So technically speaking, we have promised our social media influencer that we are going to pay you $1,200 for sales that we do on Moore Place apartment. For those sales that we do directly as a result of your influencing, we are going to pay you $1,200. But if you read the agreement closely, it's written that we are going to pay $1,200 for each deposit received, not for each sale done. You know why? Let me go back. It was written that construction of the both buildings began on 1st October and they will be completed on 31st of January XX. Can everybody read this? Yeah. So technically speaking, the sales will only happen from 1st February XX. Do you all agree? We can only sell a building in the ordinary course of building once it is complete. Do you agree with this? You see, we were supposed to sell our buildings to our customers from 1st February XX onwards. But the agreement with the social media influencer was only for 3 months and had to expire at 31st January XX. So if you closely look at it, the terms that we have agreed with the social media influencer are as such that we have to pay $1,200 for each deposit received. For each deposit received, not for each sale. Not for each sale. Do you understand this? The reason why I am emphasizing on this fact is that you see the sales are eventually going to happen on 1st February XX. But the sales commission is payable before 1st February XX. I'll repeat that once again and I want an answer from you guys. Do you understand, yes or no? The sales are eventually going to happen from 1st February XX once the building is complete. But the commission is payable or will be paid before 1st February XX. I mean, before the sale eventually happens. Do you agree with this stance? I will repeat once again, Farah. Farah, the building is only going to be complete on 31st January XX. Do you agree with this? It's under construction. It cannot be sold while until and unless it is constructed. Do you agree? It cannot be sold before it is constructed, right? So technically speaking, the sale is going to happen after 1st February, or from 1st February XX, after 31st January. After January in our world, there is February, right? So the sales is going to happen from 1st February XX. Agreed? But you see the contract terms with a social media influencer, we have to pay them $1,200 for each deposit received. So technically, the social media influencer will not wait for the eventual sale. Even if, as a result of his or her activities, even if we get a confirmed deposit from a customer, we have to pay $1,200 to them. Do you understand this point? So technically speaking, the commission will be payable or will be paid before the eventual sale. Do you agree with this? Do you agree with this? I want an answer from everybody. The sales are eventually going to happen from 1st February XX onwards, and the commission will be payable before 1st February, because the terms of the contract are, even if we receive deposit, we will pay you $1,200. Yes, yes, Farah, exactly. Does everybody understand this point? Because here I will again bring up an important issue. Does everybody understand this point, that wherever the sales are made, sales might be made 3 months after, 4 months after, 10 months after. If we receive a deposit from our end customer, the social media influencer will be paid $1,200. A sales commission will be payable even before the eventual sale happens. Is it clear to everyone? Please, please. We cannot write an answer until unless you understand this point. Understood? And here I would like to refer IFRS 15. We all have read this point under IFRS 15. The fourth standard which is being mentioned here. Guys, if you remember under IS 15, we read a paragraph which was written incremental cost of obtaining a contract. See, IFRS 15 is all about revenue from contract with customers, right? And then there was one paragraph, one small clause, which was about incremental cost of obtaining a contract. IFRS 15 said that if a cost is incurred in order to obtain a contract, and that cost will be recovered from the customer, and that cost will be recoverable from the customer, then that cost must be capitalized as a contract asset and then amortized in the same period in which revenue is recognized from the asset. It's the same point that we discussed in the earlier part. Earlier, it was within the context of leases. Here, it is within the context of IFRS 15. See, IFRS 15 has a big problem. IFRS 15 is saying, okay, when you get a contract from a customer, you recognize revenue when performance obligation has been satisfied. It is possible that you might have incurred some costs in order to obtain this contract. And if you think the cost that you incurred in order to obtain this contract is recoverable from the customer, then you should initially capitalize this cost and then charge it as an expense in the same period sales revenue is being recognized, so that matching is possible. But this cost is only those costs which are recoverable from the customer. Any cost which is incurred to obtain a contract which is not recoverable from the customer, cannot be capitalized and charged later off. No, no, no. Let me give you an example. Let's say a company issued a tender. A company issued a tender. Do you know what is a tender? What do you mean by a tender? What is a tender? No, 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 Subrat. Subrat, the right word would be a tender is an invitation to offer. A tender documents, a tender document invites potential companies to provide for an offer, provide for a proposal. Do you agree? Does everybody agree? So let's say an entity markets a tender, you go and buy that tender because you have the intention to participate in the bidding process. So this is a cost which is incurred in order to obtain the contract. Do you guys agree or not? A company issued a tender, right? A tender is an invitation to offer. The company is calling, okay, I want to construct a building. Who wants to construct this building? Come give me offers. Come give me offers. So many people buy tenders. Many people buy tenders. So technically, it is a cost which is incurred to obtain a contract, right? But Sania, is this recoverable from the customer? Is this recoverable from the customer? No, 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 no. This is not recoverable from the customer. Why? Because there is no guarantee that you will be awarded the contract, right? Anybody could be awarded the contract, right? So it is a cost, not there is no evidence to suggest that the cost that you incurred to purchase the tender will be recovered from the customer, right? From the customer, it won't be recoverable. So these type of costs cannot be capitalized. But a $1,200 commission. Do you see, commission is always on sale. Commission is always on sale. Please, please, don't say this is not related to sale. A commission is always on sale. A commission is always payable when the sale is happening, right? So this $1,200 payable to the social media influencer is payable when the sale is agreed for. When the not when the sale happens, but when the sale is agreed for. The sale is going to happen at a later date, Subrat. The sale is going to happen at a very, 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 very later date. Then here comes the problem of matching concept. The sale is going to be recognized when we eventually hand over the keys to the apartment to a customer, point in time, whenever we satisfy our performance obligation. So revenue will be recognized at a later date. But do you propose that I should recognize sales commission as an expense now? It is against matching, guys. It is against matching, right? So we use the provision of IFRS 15, which says that an incremental cost of obtaining a contract may be capitalized as a contract asset if it is recoverable from the customer, and it should be charged off in the P&L in the same manner in which sales revenue is being recognized. Does everybody understand this? Does everybody understand this? So $500 which was payable in context of lease had to be capitalized and had to be amortized over the lease term. These $1,200 will be capitalized, as a contract asset and will be recognized when the sale actually happens. In both contexts, our target is matching, but we are referring to different accounting standards, IFRS 16 and IFRS 15. Does everybody understand this? Please, please let me know. Do you understand this? Guys, please let me know. I believe this part was the most critical part for you guys to understand. If you do not understand this, it's not worth it then. Just let me know if everybody understand this part. How to write this answer, that's not your problem. I'll write an answer. But do you understand what I'm saying? Okay. So examiner says the variable fees will be paid at the end of social influencers contract on 31st January 2026 by 31st December. Now this is important. By 31st December X5, which is the current reporting date, Adrento had signed contracts to rent all the River Park apartments for the next academic year. It could identify that 75% of these contracts were the direct result of the influencers' activities. It could identify that 75% of these contracts, right? So please understand there were 80 apartments in River Park, 80 apartments in River Park for rental purpose. 75% of these came due to social media's influencer activities, and we promised them to pay $500 for each River Park apartment lease contract. So this would be the lease commission, right? Furthermore, it had also taken customer deposits on all the Moore Place apartments. So there were 60 apartments, and all are, for all deposits have been taken, and could identify that 50% of these sales were a direct result of in social media influencers activities, and therefore, $1,200 would be payable to them. Do you understand this? $500 for 75% of all the apartments of River Park, and 50% of the Moon Place apartments, on those $1,200 would be attributable to the efforts of social media influencer. Examiner says Adrento has recognized a selling asset in its statement of financial position as at 31st December X5, measured at $246,000. Uh, can anybody tell me how this $246,000 has been calculated? How this $246,000 have been calculated? Any idea? I mean, if I talk about, let's say, breakup, then there is direct one-time fee, one-time fee, or other one-time fixed fee, which is $180,000, right? Then there is something which is paid for River Park lease. Can anybody tell me how much would be paid for River Park? How much would be paid for River Park? Can anybody tell me? Guys, just see this. There were 80 apartments. So I will write 80 apartments, right? Examiner said 75% of these contracts were a direct result of influencers' activities. So multiplied by 75%, multiplied by, how much was payable on River Park apartments? $500. So this is, oh my God. This is $500. Can anybody tell me the calculation of this? What's the answer? 30,000. Very good. Okay. Okay. Can you tell me the amount for Moon Place? Moon Place sale, right? So a dollar number which can be calculated as, there were 60 apartments, right? And I remember that 50% were due to social media influencer. So 50% multiplied by, for each apartment we had to pay $1,200, right? So what's the amount here? 60. Okay, so you guys, okay, $36,000, right? Can anybody tell me what's the total amount payable? What's the total? 180 plus 66. This is 246. Okay. So this 246, what examiner is saying, Adrento has recognized a selling asset of 246,000, being the full amount payable to the social media influencer, and it intends to amortize it over 30 years useful life of a property, starting on 31st January X6. So it wants to depreciate it. My first question, can this $180,000 be capitalized? Can this $180,000 be capitalized? Give me a yes or a no. Can this $180,000 be capitalized? One time fixed fee that we are paying to social media influencer for building up our brand awareness. Can this be capitalized? No, it's an expense. It's a marketing expense. No, it cannot be capitalized. Can we capitalize this River Park lease of 30,000? One time initial direct cost to obtain a lease, Can we capitalize this $30,000? Yes. But will we depreciate it over 30 years? Will we depreciate it over 30 years, Sanya? We will depreciate, we will amortize it over the lease term of 12 months in the same manner in which rental income would be earned. Make sense? Can I capitalize this $36,000? Yes, I can capitalize this $36,000, but only as a contract asset. Since this amount is recoverable from the customer, I will initially capitalize it as a contract asset. And in order to match my incomes with my expenses, I will expense it out in the period of sale. Understood? This is the whole story. Make sense? Now, just to write an answer, the initial fixed fee. Let me write an answer for you guys. Initial fixed fee. I would refer to IS 38 here a bit. Okay. So according to IS 38, internally developed brand names cannot be capitalized, cannot be recognized as intangible assets since they lack identifiability, right? So in this case, the initial fixed fee of $180,000 payable to the social media influencer is for the purpose of building brand awareness, right? This is supposed to be a marketing expense and therefore it cannot be capitalized. Hence, adherento is incorrect in capitalization of this cost and therefore should reverse it. Make sense? This is about the initial fixed fee. Then we talk about commission payable on river park, right? Let me write an answer for you. And here I would refer to IFRS 16 first. So according to IFRS 16, uh, when an entity leases out an asset to another party for a short period of time, whereby significant risks and rewards are also not transferred, then it should be treated as an operating lease. Under an operating lease, the asset is the asset, investment property in this case, is not derecognized. Rather, the rentals received / receivable are recognized as an income in profit or loss account. Furthermore, according to IFRS 16, if an incremental cost of obtaining the lease is incurred, then it can be capitalized as part of the asset, right? It can be capitalized as part of the asset. In this case, the commission which is payable to social media influencer is the cost of obtaining the lease. It is evident that these lease contracts would not have been entered into unless the commission was payable to the social media influencer. Or I can write unless the efforts of social media influencer. This cost should be capitalized. This cost of, how much was the amount? Amount was 30,000. Yeah. The cost of $30,000 should be capitalized as part of investment property, but should be amortized over the lease term so that rental, so that there is matching between rental incomes and its related expenses. Make sense? Does everybody understand this? Please let me know if there is anything that you do not understand or anything which can be, uh, rightfully added. Commission payable on Moonplace. Commission which is payable on Moonplace is purely a sales commission. Generally, such a commission is recognized in in P&L as income. However, in this case, the sales of property, the sale of property is only possible once they are, once the construction is complete and the performance obligation is satisfied through transfer of control of the property to the customer. However, it should be noted that the sales commission is payable despite of the sale when the deposits are received. According to, I'm changing the format of it. According to IFRS 15, an incremental cost of obtaining a contract can be capitalized as a contract asset and be subsequently expensed to match the sales period if it is recoverable from the customer. In this case, the amount of $36,000 should be capitalized as a contract asset, and then we subsequently charged off in the same period when the sales revenue is recognized for each of the respective. How many apartments were there? 60. It's just for each of the respective 60 apartments. This would be beyond 31st January 2026 once the construction is complete. All right, guys. So you guys tell me, do you guys understand? Do you guys understand or not? We took a lot of time to complete the whole thing, but do you guys understand? Sir, there is a question, sir. When I saw the term social influencer, I initially thought the question might be an easy one, but I was shocked to realize how complex case could be made with IS 1642 and IFRS 15. Absolutely, Farah. No, the reason I'm doing this question with you guys in so much detail, you see, I took my time, right? I told you guys that this would be a longer class, and why to be honest, I am so happy that we got such a type of a question in a mock examination, right? Because I can understand there was so much exposure into the question that you could have, even though you would have completed this whole part, you see, exhibits 1 and 2 were easy, routine, but you could have lost a lot of marks in exhibit 3. Maybe somebody would have scored 5 marks, maybe 6 marks, maybe 4 marks, maybe 3 marks. Seldom will be the case that everybody could have been on spot and scored full 10 marks. And not because you do not know what I was talking about. I mean, you have studied IFRS 16 with me, you have studied IFRS 40 with me, you have studied IFRS 15 with me, but you haven't seen this type of a question before. And that is why this is difficult. The next time you see such type of a question, it is going to be easy because now you have done a question. So I'm so glad, I'm so happy that fortunately we witnessed such a question, because now definitely we are well prepared for our ultimate examination. Make sense? So always try to look at the bright side of the scenario. Had you received this kind of a question directly in your exam, without any precedence of such a question being into your exam, you would have, lost good 4, 5, 6 marks. Yeah. It would have been difficult to gain those lost 4, 5, 6 marks, right? But thank God we received it in mock, and we had the opportunity to have a discussion over it and solve this out. And in detail, we solved this out. Yeah. So I hope you are satisfied now. Yeah. I seriously hope that you had a good time. This was a very lengthy class, but I think the time you spent here, the extra time that you spent here is much better than spending a lot of time in 2, 3 attempts, right? So, I mean, this is all from my side. Uh, Take care. Allah Hafiz.